Now let us understand the forward pricing with known income. It means whatever forward contract you have, that asset will generate income during the period of the contract in which you are holding. So what are the income which may get generated? Suppose if you are holding a forward or a future contract in a stock will generally give you dividends and some type of cash flows. The cash flow may come in many other forms other than dividends. So any asset with known rupee income, how do we calculate the future price of that stock or the asset? So asset with known rupee income. So what are the various factors we should consider? The first one is modified portfolio construction we have to undertake. So for that, let us consider two portfolios with identical payoffs at maturity T. What are those two portfolio? One is a portfolio with a long forward contract plus cash k into e to the power of minus small r into capital T, which we have already discussed and derived. And there will be a portfolio B with long asset plus the reinvestment of all the income which is generated during the period of the contract. That is, the period of contract is capital T. During this period of contract, it may be 3 months, 6 months, 1 year, whatever it is. During that period, if the asset generates any income, so we are taking the reinvestment of all those income plus the long asset as the portfolio B. Okay. Now, what is the present value equivalence? The present value equivalence of the portfolio A is k into e to the power of minus small r into t, whereas the present value of the long asset plus the reinvestment of all income will be as below. See, the cost of the portfolio B, if we consider it today as S0, but we know that we receive an income with the present value of I. So, the net cost of the portfolio will be whatever the income which is generated during the period of the contract, that the present value of that income, that is I, minus this present spot value of the asset S0 will give you the net cost, that is S0 minus I. S0 is the spot value of the asset and I is nothing but the present value of all the income that will be generated by the asset during the period of the contract. So S0 minus I will be the cost of the portfolio B or the value of the portfolio B. So what should happen? We know that k into e to the power of minus small r into t is nothing but the future value f0. So f0 should be equal to s0, that is the spot price of the asset, minus the I is what? Present value of all the income that will be generated by the asset during the period of the contract, into e to the power of small r into capital T. So what happens here? What do we understand? Whatever the income that gets generated during the period of the contract will reduce the forward price of the asset because the forward holder does not receive these cash flows. Now, let us take an example. Forward price on a dividend paying stock. Let us analyze a stock currently trading at rupees 50 and it will pay dividends of rupees 2 in 3 months. So we have to calculate the present value of 2 and rupees 2 in 6 months, and again we have to calculate the present value of rupees 2. The risk-free interest rate is 4% per annum with continuous compounding. So calculate the 9-month forward price. So we are supposed to calculate 9-month forward price. Now let us calculate the present value of all the income that will be generated. What is the present value of rupees 2? It will be rupees 2, that is 2 into e to the power of minus 4 divided by 12 into 0.04. So it will be I is equal to 2 into e to the power of, it is 3 months contract. The income is generated after 3 months. So the present value will be 3 by 12. So 3 by 12 will be 0.25 into what is the risk free interest rate? Annual risk free interest rate is 4%. That is 2 into e to the power of minus 0.04 into 0.25. Similarly, The present value of rupees 2 received after 6 months will be 6 by 12 into 0.04. That is 6 by 12 is 0.5 into 0.04. So the total income generated and the present value of that income is rupees 3.94. So this rupees 3.94 will get deducted from rupees 50 because it is the spot price. So what is the formula? Formula is future value is S0 minus I into e to the power of R into T. So that is 50 minus 3.94 into, here small r is 0.04. What is capital T? Capital T is 9 month. Okay. The capital T is 9 months. That is 9 divided by 12. So 9 divided by 12 is nothing but 0.75. So it is E into e to the power of 0.04 into 0.75, which will give you the future price as 47 rupees 46 paisa. Here we can see that the forward price 47.46 is less than the spot price 50. Why? Because the dividend payments reduce the cost of carry of the this stock, which is presently trading at rupees 50 by rupees 3.94. So you will get the future value as 47 rupees 46 paisa. Now, in the previous conversations, we said that the asset will generate a predetermined income based on the present value of all the income generated during the period of time. But more often than not, what happens? The income generated is usually referred in terms of yield. Yield means what? Interest rate. So you may say that a asset is generating 1% yield. It means it is generating 1% income of its spot price. That is known as yield. So if we consider Q as the yield generated by the asset over the period of the contract capital T, then the formula which we are going to use is F0 is equal to S0 into e to the power of R. What is R? Risk-free interest rate. We are reducing Q from risk-free interest rate because Q is nothing but the yield which we are receiving from the asset. Okay, so we have to reduce Q from the R, which is the risk-free interest rate. So the known yield Q represent income as a percentage of the asset's value rather than a fixed dollar amount. In the previous calculations, we considered a fixed dollar amount by calculating the income generated and then getting the present value of that income to get value I, which is nothing but the present value of all the income generated. But here we are representing the income generated as a yield. Yield means percentage, as a percentage of the asset value. Now, dividend yield is nothing but this Q is nothing but the dividend yield. So, for stock indices, Q represents the dividend yield earned by holding the portfolio of stocks. In case of currencies, Q is the foreign risk-free rate representing interest earned on foreign deposits. As far as commodities are concerned, minus Q can represent storage cost as a percentage of the spot price. See, storage cost will always get included. That's why now the yield is given a negative value. Here yield is all positive, right? Here Q is positive, Q is positive. But as far as storage is concerned, it becomes minus Q. So the formula for forward pricing with known yield is given by F0 is equal to S0 into e to the power of R minus Q into capital T. Now, let us come to the concept of valuing of the forward contract. See, there is a huge difference between a forward price and a forward value. It is very important for us to distinguish between a forward price and a forward value. See, the forward price F0 is nothing but the delivery price that makes the contract value 0 at inception. So, whatever the contract value, the delivery price which makes that contract value 0 at inception is the forward price. Forward price is nothing but the price which is agreed upon between two individuals when entering the contract. So F0 is chosen so that no money changes hands at the inception, whereas forward value is something slightly different. It is the current market value of an existing forward contract. Whatever forward contract you are holding, The current market value of that particular forward contract is called as the forward value. Here the forward value changes over time because the market conditions also evolve over a period of time. The value fluctuates with spot price and time, and this value can be either positive or it can be negative. So the forward value starts at zero and fluctuates either to the positive side or onto the negative sides with the market movements, representing the contract's profit or loss if closed out at the current market price. It means if the spot price is forward price is positive, then you earn some profit if you close it out immediately, or if the forward price is negative at that any particular point of time, then in such case you are going to lose out on the uh, contract. Let us understand the value of a long forward contract with no income case. So let us analyze this with the help of an example. So we are having a long forward position which is established at time 0 with the delivery price K. So at time 0 we have agreed upon to pay a price K for any asset to be taken as a delivery by us. So the current time is small t and maturity is capital T. So we can consider generally as if we consider maturity as 6 months, the small t will always be less than capital T. So small t can be 2 months, 1 month, 20 days or something like that. The current spot price is ST. So if we say that the current time is 1 month from the initiation of the contract, then ST will be 1 S1, that is 1 month has completed. So the spot value after completion of the 1 month of the forward contract is ST, and the risk free rate is R. The forward value represents the difference between the current forward price and the locked in delivery price K discounted to present. It is so simple. See, once you initiate the contract, the forward contract price may go positive or negative. Understood? After that, at any point of time, small t, the spot price will be ST. So when you calculate the current forward price and you deduct the current forward price from the present value of the delivery price K, then that will be the value of the forward contract. The value of the forward contract can be positive or it can be negative. So F is given by ST, that is the present spot price, minus K into e to the power of minus small r into capital T minus small t. Why are we subtracting small t from capital T? Only because small t time has already elapsed. So we have to calculate the present value for capital T minus small t, not capital T. Okay. Suppose if we say the small t is equal to 1 month and capital T is equal to 6 months, then the time left is 5 months, right? So then we have to calculate the present value of the delivery price K deducted for 5 months. Understood? So we have to discount it for 5 months at a rate of interest of small r. Alternatively, we can view this as the present value of the expected payoff at maturity. Very simple, I'll tell you. See, F can be taken as what is ST is nothing but FT minus K into e to the power of minus small r into T minus T. What is FT into e to the power of minus small r into capital T minus T? It is nothing but the value of the forward contract, value of the forward contract discounted to the present value. So we are subtracting where what is FT then? What is FT? FT is ST into e to the power of R T minus small t is the forward price for a new contract initiated at time t. So what are we taking? We are taking FT is nothing but a new forward contract initiated at time small t when small t time has been elapsed. That will be equal to ST into e to the power of R into T minus T. Correct? Makes sense. So we are replacing st with ft into e to the power of minus small r into t minus t. So we are getting this value f is equal to ft minus k whole bracket into e to the power of minus small r into capital T minus small t. This is a very simple formula calculation, manipulation of the formula. So here st has been replaced by ft into e to the power of minus. When you bring this whole entity to the left side, this entity e to the power of small r t minus t will become negative. So that is what has been represented. So if you say ft into e to the power of minus small r into t minus t, I hope you understood this concept. Now, how does it evolve? Let us say at the inception of the contract, the delivery price K will be set equal to F0, which is equal to S0 into e to the power of RT. We all know that the first formula which we derived, value of the future contract, price of the future contract F0, and the contract value F, that is the value of the contract, will be equal to 0. So at the inception, so no payment is required to be entered. But during the contract life, when small t lies between 0 and capital T, as the spot price changes, that is st changes, value of the future diverges from this 0. So if st rises, the long position gains value, and if st reduces, the long position will lose value, because f is nothing but st minus k into e to the power of minus r into t minus t, which is greater than 0. As we approach maturity, time value will shrink as e to the power of minus r into t minus t tends to 1. See, arrow means it tends to 1. So this value, see, e to the power of 0 is 1. That's why when this value start becoming smaller and smaller and smaller, the value of e to the power of anything will be almost reach 1. As we know, value of e to the power of 0 is 1. So value converges to f, which is nothing but st minus k, the immediate profit which you get from delivery. See, this st minus k concept will be used in the calculation of the option prices, and various strategies used in the options, like long contract, iron condor, and all those strategies which are used in the option generally follow this principle only. At maturity, small t will be equal to capital T. So forward value equals payoff. What is the payoff? F is equal to payoff will be st minus k. If the spot price at the time of termination of the contract is greater than k, there will be profit. And if the spot price at the termination of the contract is less than the delivery price, then the person who is holding the long contract will lose money. That is what has been explained here. See, long benefits if st is greater than k, and long losers if st is less than k. So let us understand what will be the value of the contract when there is a known income. See, when the underlying asset provides income with present value I, which we have already calculated and explained, the forward value becomes what? F is equal to st minus I minus k. See, we are just adding this particular value here, minus I, into the equation. That's all. St minus I minus k into e to the power of minus small r into capital T minus small t, bracket close. So the income which we have received, it reduces the forward value to the long position, because the forward contract holder does not receive these cash flows during the contract's life. The short position benefits, the person who is holding the short position will get benefited correspondingly. So when the person holding long forward contract will not get any dividends or income, but the person who is holding short position will get all those benefits. Now, value with known yield. We calculated their value with known, income. Here we are substituting value with no known yield Q. It is very simple. The value of the forward contract will be st into e to the power of minus q into capital T minus k into e to the power of minus small r into capital T minus small t, bracket close. So what is this e to the power of minus q? It is the present value of the yield for the leftover time t minus small t. Whereas k into e to the power of minus qt minus T is the present value of the forward price for the leftover time, capital T minus small t. We can express this in terms of current forward price Ft, where F is equal to Ft minus K into e to the power of minus small r into capital T minus small t, where we know Ft is equal to St into e to the power of r minus q into t minus small t, where t minus small t is nothing but the residual time left. Let's take an example for forward value evaluation. So there is a 1 year forward contract on a non-dividend paying stock. So it is non-dividend paying. It was entered 3 months ago. So this contract was entered 3 months before with delivery price equal to 105. That is K is equal to 105. It is what? It is a 1 year forward contract. You have to be clear. It is a 1 year forward contract. Contract was entered 3 months ago. The stock now trades at 110 and the risk free rate is 5% per annum. So what do we understand? Here the current spot price is 110, delivery price is 105. The contract was entered 3 months before, that is small t is 3 months. Small t is 3 months and capital T is 1 year. So what is the maturity time left? The time to maturity is 12 months minus 3 months, which is equal to 9 months. See, 9 months is equal to 0.75. Why? 9 divided by 12 will be 0.75 years. You are converting months to years, that's all. No great mathematical equations are being derived here. Now the risk-free rate R is 0.05. So what is the formula forward value? The value of the contract will be ST, that is the spot price at point time T, small t, that is spot price after 3 months minus the delivery price after 1 year into e to the power of minus risk-free rate into the time remaining to maturity. So here F is equal to ST is 110 minus delivery at the time of maturity is 105 into e to the power of risk free rate is 0.05 into T minus T, here is 0.75 years. So you get the value of the contract as rupees 8.86. So what is the meaning of this? The long forward position has gained 8.86 rupees in value as the spot price has increased from the implied level at inception. So we do not know the what was the spot price at inception, but the present spot price at 110 and the value of the forward contract of 8.86 indicates that there has been a positive change in the spot price of the contract. Now, stock indices as assets with known yield. So, what does it mean? If we consider stock index futures, in stock index futures, uh, this index future generally represents a combination of various stocks of the index. If we consider Nifty 50 stock index future, then that it generally represents all the Nifty 50 stocks in the Nifty 50 index. Now, some of these stocks may give dividends. So when we calculate all these dividends together, so what are we going to get? We are going to get what is known as the yield. So what are they going to do? They are going to consider the dividends which has been received as a percentage of the spot price of the contract. That is called as yield Q. So we model dividends as a known yield. Known yield means Q. What is the yield which you are going to represent? It is representing the average dividend yield of the index constituents. Index constituents means the stocks which form part of the index which are giving dividends. So what will be the pricing formula, futures pricing formula for this? Since you are going to receive dividends as a percentage, so you will subtract this percentage from the required rate of return, that is the risk free rate which is set, because since you are generating an income from the asset, so that will reduce the spot price, hence the future price will also accordingly reduce. So spot price into e to the power of small r minus capital small q into capital T will be the value of the future contract. So what is the understanding of this equation? It says that the future price gets reduced by a percentage equal to the yield of the dividends which are received from the constituents of the index in which you are taken the future position. So S0 is equal to current index level, R is the domestic risk free rate, continuously compounded, and Q is nothing but the dividend yield on the index. So you are taking a dividend as a percentage of the index. That's why it is called dividend yield on the index. And T is the time to maturity in years. So this is the formula for index futures. So the index future formula is given by S0 into e to the power of small r minus small q into capital T. Now let us take the no arbitrage conditions for this. If we consider portfolio A as long future contract with no initial cost plus cash which is equivalent to the future price, that is the delivery price k into e to the power of minus small r into capital T, which we have already derived in the initial derivation of the future contract, invested at the rate r. So what are we doing? We are taking the present value of the future delivery price. At maturity, what are we going to do? We are going to pay F0 for index worth ST plus the cash that grows to F0. So total value will be nothing but the spot price at maturity. T is the time to maturity, right? So ST means spot price at the time of maturity. In portfolio B, what are we doing? We are taking a long position in e to the power of minus q capital T units of the index. So if you take the yield, whatever is the yield which is giving dividend yield, and multiply it with the total time of the contract, and you do the continuous compounding and multiply it with the index, you will get the long on the number of units of the index. So at maturity, with dividends reinvested at the yield q, this grows exactly to 1 unit of the index. It is common sense. Worth ST, that is the spot price at the time of the maturity. So both portfolios, as per the no arbitrage condition, should be equal. So F0 into e to the power of minus RT should be equal to S0 into e to the power of minus QT. So solving for F0, what do we get? F0 is equal to S0 into e to the power of R minus Q into T, capital T. This is what exactly we derived in our previous slide. Let us take an example. So S&P 500 index currently stands at 4,000. We are talking about S&P 500 means it is a US index. Okay, stands at 4,500. The dividend yield is 1.8% per annum. So the dividends which is being received is 1.8% of the index, and the risk-free rate is 4.5% per annum. So both are continuously compounded. So what are we supposed to do? We are supposed to calculate the 6-month future price. That is capital T will be 6 months. 6 months means 6 by 12, it becomes 0.5 years. So we apply the formula which we have derived. F0 is equal to S0 into e to the power of R minus Q into T. So you generally get value of the F0 as 4561.2. Foreign currency forwards and futures. See, this is derived through interest rate parity and exchange rate derivatives. See, a foreign currency can be viewed as an asset that provides a known yield equal to the foreign risk-free interest rate. What does it mean? Suppose I am holding, dollars. What is the rate of interest given to dollar in America when you invest in the American GSEC or something, which is generally considered as the risk-free rate. So so we are considering the foreign risk-free rate. What is the risk-free rate in the currency in which your foreign currency which you are holding? So when you hold foreign currency, you can either invest it at the foreign rate of interest, that is RF, or you can interest in the domestic rate of interest. Correct, risk-free rate. So you are getting two risk-free rate. One is small r, which is the domestic risk-free rate, and another is RF, which is the foreign risk-free rate. So you can invest in either of the two places. So if we consider the domestic perspective, what will happen? So here we can analyze the forward exchange rate in the domestic currency per unit of the foreign currency. Whereas if we take foreign interest as yield, then the foreign risk-free rate RF represents the dividend yield earned on the foreign holding of the currency. So then we apply the no arbitrage principle and say that whether you hold, suppose if you are having $1, suppose you convert the dollar into rupee and invest in India, or you keep the dollar and invest in America, and whatever the risk free rate they give you, both of them should be equal. That is the no arbitrage principle which we are trying to analyze. So what does it mean? If you are having a foreign currency, either you can convert that foreign currency. Let us take example of $1. See, today $1, if it says it's equal to 100 rupees, you can convert this dollar into 100 rupees and invest in Indian market, and you get a risk free rate equal to small r. But however, if you say I will invest in America itself, then you will invest $1 at the risk free rate, that is RF, in America itself. So if there has to be no arbitrage, then these two should be equal. That is what this all this statement is trying to imply. So what is will be the forward exchange rate? The forward exchange rate is nothing but the difference between the domestic exchange rate, domestic risk-free rate, and the foreign risk-free rate. So the future price F0 will be equal to S0 into e to the power of R minus RF into capital T. Why? We said F0 into e to the power of Rf into capital T should be equal to S0 into e to the power of R into capital T. Then we took e to the power of Rf into T this side, so it became minus. So we got this equation. So where S0 is the spot exchange rate, that is the domestic currency per unit of the foreign currency, and R is equal to domestic risk-free rate continuously. R is the domestic risk-free rate continuously compounded, and RF is equal to foreign risk-free rate continuously compounded, and T is the time to maturity in years. See, this is exactly equal to the, I know if we replace RF by Q, we will get the same equation, the future price when it is giving an yield of Q as a percentage of the spot price or index. Now, what is covered interest rate parity? See, the currency forward formula embodies covered interest rate parity, that is CIRP, a fundamental no arbitrage relationship linking spot rates, forward rates, and the interest differential. So, as I have explained, you can invest domestically, invest 1 rupees at domestic rate of interest of small r for a period of time t, and value of at maturity will be equal to e to the power of small r into capital T. This is the domestic unit. The strategy 2 should be convert rupees 1 to 1 over S0 foreign units, because you're converting it into dollars, and invest at foreign rate of interest RF to get 1 over S0 into e to the power of RFT, that is the foreign currency interest generated risk free rate, and you are going to lock in the forward rate F at F0 to convert back. So what will be the value at maturity? The value of at maturity will be F0 divided by S0 into e to the power of RF into T domestic. So the no arbitrage condition requires that these two should be equal. That is, e to the power of RT should be equal to F0 by F0 into e to the power of RF divided by RF multiplied by T. So this will yield you the same equation which we have just discussed. Now coming to the commodity futures. See, unlike financial assets, we know physical commodities incur storage cost. Okay, what are the costs? The cost of warehousing, the cost of insurance, the cost of spoilage, and cost of handling. So these costs must be incorporated into the future pricing. So this will effectively increase the cost of carry or the cost of holding the asset. So physical storage means what? Warehouse rental, security, climate control. So this is typically charged as a percentage of the commodity's value or as a fixed fee per unit. So it can be either way. Similarly, insurance and risk, that is insurance against fire, theft, natural disasters. So we have to take into consideration the insurance also. And some of the agricultural products deteriorate. So hence we have to consider deterioration also as a cost. So how do we achieve future pricing with storage cost? So we know that the future price will be equal to spot price into e to the power of r plus u into t, where u is the cost of storage as a proportion as a percentage of the spot price. So some also, if the storage cost is taken into consideration based on the present value u, then the future formula will become f0 is equal to s0 plus that u, because u is the present value of the storage cost into e to the power of small r into capital T. Here u is in percentage, here u is in normal rupees, here u is in percentage. In question they may ask the uh, the storage cost will be 1%. Here they may say the storage cost is 50 rupees. So in such cases you are going to add that 50 rupees to the spot price. In this case, if they say the storage cost is 1%, then that 1% should be added to the risk-free rate to get the future price. So future price will generally increase with the increase in the storage cost, because storage cost is also a cost of carry. Now let us take an example. See, gold price is 1800 per ounce, risk-free rate is 4%, storage cost is 0.5% per annum. It is continuously compounded as a proportion of the spot price and calculate the 9-month future price. So we know all the data. All we have to do is plug in the values. The future value will be equal to spot into e to the power of r plus u into t, which is nothing but 1861.74. So the future price of 1861.74 exceeds the spot price because the cost of carry has increased. Okay. So this cost of carry is, what is it reflecting? It is reflecting the financing cost of 4% and storage cost of 0.5%. See here, 1861 minus 1800 is 61 rupees 74 paisa. So financing cost is 4% of 1800 is for period of 9 months is 54 rupees, and storage cost of 5.5% of 1800 for 0.757. So this also equals 61 rupees approximately. Let us understand what is convenience yield. See, there are certain items like agricultural products and industrial products, industrial raw materials, which becomes premium in case of scarcity of those items. So this can include your oil, natural gas, and agricultural products. So the advantage of holding these raw materials in excess is known as the convenience yield, because you can bid higher rate to sell that product, and that higher the capability for you to sell these commodities at a higher price is called as the convenience yield. So if you consider future price with convenience yield, you have to subtract the convenience yield from the storage cost. So if y is the convenience yield, then the future price is s0 into e to the power of r plus u minus y into capital T. We will not go into the detail of what is backwardation and contango. I will just explain backwardation is nothing but the future price will be less than the spot price. This will happen only when the demand for the commodity is very high in the short term and very low in the long term. In such cases, the spot price will be higher than the future price, and that is called as backwardation. During strong backwardation, the convenience yield will be very high and it will be greater than the cost of carry. Whereas in case of moderate contango means when future price is greater than the spot price. In case of contango, the cost of carry, that is r plus u, will be greater than the convenience yield y. So generally we can say the cost of carry will be equal to r, that is the cost of raising the finance through the risk free rate r, plus the storage cost u, minus the convenience yield q, and minus the yield which you are receive, that is, so the cost of carry will be equal to the cost of raising the fund through risk free rate r plus the cost of storage minus the yield which you receive from any of the financial product minus the convenience yield of any commodity or product which you are holding. So where r is the risk free interest rate, u is the storage cost, q is equal to dividend or income yield, and y is the convenience yield. So here the future price can simply be expressed as F0 is equal to S0 into e to the power of C into capital T. What is C? C is the net cost of carry. This the R plus U minus Q minus Y is your C. See, if you generally compare non-dividend paying stocks will have a cost of carry of around 5%. Stock index will have a cost of carry of about 2.75%. Foreign currency has a cost of carry of about 1%. And gold has the highest cost of carry is more than 5%. And crude in fact has got a negative cost of carry. Now coming to securities lending and borrowing. See, securities lending is a critical mechanism in the stock exchange, because people who are doing short sales, they need stocks and at very short notices. So who are going to provide these stocks for the traders who are gone short in the market? And this supply of the stocks for a very short period of time for the big traders and hedgers come from the financial institution holding the stock in very large quantities, like pension funds, mutual funds and others. So they are capable of providing the shares to the hedgers and portfolio managers for a very short period of time with some interest charged. So let us see how this securities lending and borrowing mechanism operates. Nowadays, bank receipt has been banned after the Harshad Mehta scam. See here what happens. The in securities SLBM, it says securities lending and borrowing mechanism. Here stock lender, basically pension funds, mutual funds, and insurance companies, they will hold large stocks in very large quantities, because they will hold the stock for very long period of 10 years, 15 years. So whenever a borrower, he can be a trader, a hedger, or portfolio manager, he is in need of stocks. What he will do, he will borrow these stocks from these big lenders, and he will use this borrowed stock for short selling in the open market, or to fulfill a delivery obligation. So this is the borrower. So what is the borrower supposed to do? Borrower is supposed to give collateral in terms of bonds or shares or the G-SECs, that is government securities. The quantum of collateral will be 110 to 125% of the stock value which has been given to him. Now, in case the borrower default, there is a SLBM platform, clearing corporation is available with the securities lending and borrowing mechanism. What do they do? Whatever bond shares or G-SECs which are pledged, they are going to auction it, and that money will be given back to the lender. In the meantime, what can the lender do? The lender, when he has received this bonds or shares or G-SECs, he will invest it for a very small period of time, and he will generate some interest out of which. So this is the whole process of securities lending and borrowing mechanism. We will understand bank receipt, but nowadays bank receipt is not in existence. But in order to understand Harshad Mehta scam, you should know how bank receipt works. See what happens. There is a selling bank which holds real government securities which they are selling, and there is a buying bank who wants to buy those government securities from the selling bank. So here there are two entities. One is a bank selling the government securities, another is a bank which is buying those securities. Now the securities are held with the selling bank. So what does the bank do? It will issue bank receipts, saying that suppose it has sold 10,000 bonds to buying bank. Now it will give an issue a bank receipt stating that I am holding 10,000 bonds which I have sold to you. So this buying bank will take it as a receipt, and over a period of time, this securities get transferred to the buying bank. So this movement of bank receipt and the actual movement of the government securities happen within a period of T plus 2 or 14 days, whatever it is validity period which is there. So how does a ready forward deal work? Seller bank needs short term funds, so it issues bank receipt as a collateral promise. So buyer banks pay cash against this bank receipt, and seller repays cash plus the interest at a later date, and real securities are physically transferred to the buying bank. So the whole bank receipt system worked based on trust. So this trust was broken by the Harshad Mehta, who acted as an broker between selling bank and buying bank, and then siphoning huge amounts of money by making the seller bank issue uh, fraud bank receipts, even though they do not have that much of security, and taking money from the buying bank. So this is about bank receipt.